Hello everyone, welcome back to our weekly webinar series. My name is Faiza Hashmi. I'm the tax director here at Quest Cooper. Every week we have been discussing key areas of corporate tax and giving you updates of the recent amendments that have come through cabinet decisions, ministerial decisions, and the guides. So if you have missed any of our webinars, all our webinars are available on our YouTube channel. And you can look at those, and if there's any query, you can always send us an email at info@questcooper.com. Today, I've been joined by Mahar Afzal, who's the managing director. So Mahar will share the PPT. So like I said, that all these webinar lectures we have already conducted, and if you are interested to learn more about these topics, you can go to our YouTube channel and have a look at these webinars, which are all saved there. So today I will be taking you through a snapshot of the transfer pricing guide. This webinar we had done 2 weeks ago when the transfer pricing guide had come out. So FT had introduced this transfer pricing guide because transfer pricing, it's a very complex discussion and a complex topic. So a detailed guide has been come out. This guide, it explains the transfer pricing principles, gives you a view of the arm length principle, the documentation requirements. It also explains the different methods, when to use the method, and it's very detailed. It has a lot of illustrations and examples as well. So as we had promised that after the overview of the guide, we will be discussing each element in detail and having webinars on the focused areas. And so I will take you through the recap of that lecture, and then Mahar is going to take you through the topic of today, which is that we are discussing one of the transfer pricing method in detail. So why is there a need to have this transfer pricing rule? So why do they exist? So there is a need for the transfer pricing rules because the transactions which the companies are doing with related parties, they might not be at arm's length. They might not be done in the same way as that they are being done with the third parties. So there is a lot of margin where the profit shifting can be done from high tax jurisdiction to low tax jurisdiction, and then prices could be set in such a way to do this manipulation. So that is why they're already in other jurisdiction where corporate tax law is present. These transfer pricing guides are already there, and now UAE has also introduced them because this ensures, these transfer pricing rules ensure that the transactions which a company are doing with a third party and with a related party are comparable, that they are the same, and that there's no profit shifting or leakage of tax. So they are the same which have also been introduced in the OECD guideline, and the arm length principle basically tells us that we should identify the related parties first, do a comparatively analysis, then select a transfer pricing method, and then set a transfer pricing price. So to do this, how would we identify who a related party is? So the corporate tax law, it has identified who are the related parties. So Mark, can you shift to the related party slide? Yeah, so under the related party, under the corporate tax rules, the related parties are natural persons who are, up to having up to 4 degree of kinship, or is a natural person in a company, a judicial person where the natural person is either the owner of the company or has more than 50% shareholding or controls that related party, or where there are two or more than two companies, then one is the owner or has 50% or more shareholding or controls the other company together or alone. If there's a person and a permanent establishment, those will be considered as related parties. Any trustee, founder, settlement, or beneficiaries of trust or foundation, they are related parties. And partners, if they're in the same unincorporated partnership, they are related parties. So once you've identified who the related parties is, and can you shift to the next slide? So, and you have to identify who the connected persons are. So connected person under the laws are the owners, the directors or officer of the company, or any related party of the owners or officers. So basically, once you have identified who the related parties are, once you have identified who the connected persons are, then you have to do the comparatively analysis. Can you shift the slide? So the comparatively analysis basically is a detailed examination. It tells you to compare the controlled transaction, which is the one done with the related party, that with the uncontrolled transaction, which is that done with a third party and which is comparable. So for that, to do that comparative analysis, you can consider the internal comparables, which are the transactions done within the same organization, or external comparables as well, which are the transactions with unrelated parties. So this is there to ensure that the prices and the terms are the same for the transactions which are done with the related parties and that done with the third parties. So then there are transfer pricing methods, which we had discussed and given you an overview of. So there are various transfer pricing methods. They are also the same under the OECD guidelines. There is comparable uncontrollable price method, which Mahar will be discussing in detail today. The resale price method, the cost plus method, these are the traditional methods. Then transactional net margin method and transactional profit split methods. So all these methods. So the company they're going to choose that based on different criteria. So some methods are good for some industry, some kind of business, which we will be discussing in detail. But just to give you a little overview, Maya, can you change the slide? So there are certain criteria that you need to see, take into account some factors while you're selecting the transfer pricing method. So the contractual terms, what are they for the transaction, the characteristics of the transaction, what are the economic circumstances under which the transactions are being conducted, what are the functions being performed, assets employed, the business strategies which have been employed by the related party. So all these factors you have to consider while deciding which transfer pricing method to utilize. So documentation requirement. So why is there a need for the documentation requirement? This is to give FTA the clear view of what are the transfer pricing policies being maintained by the companies, what are the transactions being done with the related party, what are the methods that have been chosen, what are the basis for those methods, and the things that come under the documentation requirement is a transfer pricing disclosure form that needs to be filled by everyone. There's a master file and local file. This is should be maintained by companies where they are part of the multinational groups and the consolidated revenue is 3.1.5 billion, or taxable person has a revenue of more than 200 million during a tax period. So these are the people who need to maintain these master file and local file. And then country by country report, which is also required to be maintained by a multinational company which has the revenue of more than 3.15 billion consolidated revenue. So master file. So master file is basically a high-level overview of the group. So it tells you about the group's organizational structure, the description of the businesses, the list of the intangibles, what are the intercompany financial activities performed, the financial and tax position of the multinational company. So it's a high-level view of the whole group and their business. So then there is a requirement to maintain a local file. So this local file is more detailed. It has more, information about the local entity, what are the transactions about each category of the control transactions done with the related party, all the financial information about the local business. So this is a more detailed report in addition to the master file. This is supposed to be maintained. And apart from this, there's country by country reporting. So like we had mentioned that wherever the multinationals have more than 3.15 billion of revenue, they need to maintain this. And the CBCR report, it requires information like the specific tax jurisdiction that you have of the multinational companies, what are the taxes paid in these jurisdictions, what is the income being earned from these jurisdictions, and number of employees, tangible assets. So these kind of information is required. So in our next lectures during the next 2-3 weeks, we will be discussing all of this in detail. Like we said, we will discuss the documentation in detail, all the methods in detail, and the guide in detail. So I will hand it over to Mahar now, who will take you through today's topic, which is about discussing comparable uncontrollable price method. So Mahar, over to you.
Thank you very much, Faiza. Thank you very much for giving us an overview of the transfer pricing. So today we are discussing comparable uncontrolled price method of transfer pricing. So what is comparable uncontrolled price? As Ms. Faiza, she has already discussed, there are various methods to assess the transfer pricing. So what is transfer pricing? What should be the transfer price between the related parties and between the connected persons? There are various methods. Out of these various methods, there are some traditional method and some are transactional profit methods. In the traditional method, which are called recommended methods as well, first of all, the comparable uncontrolled price method, resale price method, cost plus method, transactional net margin method, and profit transaction and profit split method. So first of all, what are we going to do? We are going to discuss comparable uncontrolled price method. What is comparable uncontrolled method of transfer pricing? Just look into this example. There is a one party A. This party is selling goods to the party B. Both are related parties. So whatever the price that the A is charging from the B, this price can be a controlled price. Might be A is managing the price. The value of the goods in the market is assuming 100. A is selling at 110 or 90. Means A is not selling the goods to the B at the market price. Means this is a controlled transaction. At the same time, A is supplying the goods to the third party as well. C. C is not a related party. So A is supplying the goods to B, which is a related party, and at the same time, A is supplying the goods to C, which is not a related party. So for sure, A will be charging the price to C at the market value because these are not related parties. B is a related party, might be the price is a compromised price. So whatever the price that the A is charging to C, principally A would have charged the same price to B as well. At the same time, we can say this party B is buying goods from the market. There is another supplier, which is D. So D is supplying to goods to B, A is supplying goods to B, A is supplying goods to C as well. So what is the control transaction where the price can be compromised? The price in between A and B can be compromised. Here the price can be compromised because both are related parties. So if we are comparing the price in between A and B, which are related party, with an uncontrolled transaction price, this is uncontrolled. A and C is uncontrolled transaction. In the same way, D and B, this is also uncontrolled. So if we are comparing the price of a controlled transaction with the price of an uncontrolled transaction, under the similar circumstances, this is called comparable uncontrolled price method of transfer pricing. In simple words, I will say whatever the price A is charging to B, whatever the price A is charging to C, principally A would have charged the same price to B as well, because between A and C, this is the uncontrolled transaction. The price will be at the market value. Principally, A would have charged the same price to B as well. In other words, we can say if the D is supplying goods to B, whatever the price D has charged to B, because both are not related parties, A would have charged the same price to B as well under the similar circumstances. So if A is charging to C, if we are comparing the price, whatever A has charged to C with the price, whatever A has charged to B, this is called my internal comparable. Whatever D, the price the D has charged to B, this is called my external comparable. So what is comparable uncontrolled price method? I can say CUP. What is the CUP method? This CUP method is where we are comparing the price of a controlled transaction with the price of uncontrolled transaction under the similar circumstances. This is called comparable uncontrolled price method of transfer pricing. So principle, this is very logical. Whatever A is charging to third party under the uncontrolled environment, A would have charged the same price to B under the controlled environment. If A is charging the same price to B, we can say the transaction is at the arm length. If A is charging a different price to B, we can say this is a compromised price of the transaction. So through the CUP method, through the comparable uncontrolled price method of transfer pricing, we can assess what should be the fair market value for the goods and services for the transaction which is being happening between the related parties. This is a comparison in the price of a controlled transaction. It I mentioned in the definition as well. This is the comparison between the price of a controlled transaction with the price of an uncontrolled transaction under the similar circumstances. This word is very important. Under the similar circumstances, we'll discuss in detail. So in this, what we will be liable to do? We will be liable to identify what are the related parties, A and B. What is a controlled transaction? Yes, any transaction between A and B, we can assume it can be a controlled transaction. Then we need to identify the uncontrolled transaction, that uncontrolled, basically unrelated parties. A and C are unrelated parties. B and D and B are unrelated parties. Then we need to identify the transaction, similar transaction under the similar circumstances. We are assuming the goods that the A is selling to B, A is selling the same goods to C as well, means same goods, similar circumstances, almost the same terms and condition. So this is the uncontrolled transaction. We need to identify related parties, third parties, controlled transaction, uncontrolled transaction, similar circumstances. Then we need to go for a comparison. We need to make, if everything is same, circumstances are same, functions are same, input terms are same, goods are same, volume is same, everything is same, the price should be same as well. If the circumstances are different, input terms are different, volume is different, nature of the goods is different, location, supply, there's some sort of, if there's a difference, then we need to make adjustment to make sure that the price, whatever A is charging to B, it would have been same what the A is price the A is charging to C. So this is called, coming back to the basic definition, this is called comparable uncontrolled price, where we are comparing the price of a controlled transaction with the price of uncontrolled transaction. And to adjust and to identify this price, we will be liable to identify the related parties, transaction between the related parties, third party or unrelated party, uncontrolled price of the uncontrolled price of the transaction between third parties. Then we need to compare, if required, wherever we need to make the adjustment as well. So for these purposes, how can we identify the price of uncontrolled transaction? I have already given you one example. Between A and B, A and B controlled transaction, A and C uncontrolled transaction, D and B uncontrolled transaction. This portion is called controlled transaction price. This portion is called uncontrolled transaction price. This is called internal comparable. This is called internal comparable. The price at which A is selling to B, the price at which A is selling to C, this price is called by internal cup. Internal cup is where the arm length price of the controlled transaction is determined by the price of similar transaction between one of the related parties, the connected party, and the third party. This is my internal comparable. This is my external comparable. Whatever D is charging to B, might be D is selling the same goods to any other party in the market, E as well, under the same circumstances, similar nature of the goods. So whatever the price D is charging to E, again, it will be considered my external cup. I have given you an example here. This is a shareholder. This shareholder has a company A and company B. Once this is a shareholder is same company A, company B, as it has been already defined in the previous slides, mean these are related parties. Whatever price A is charging to B, this is called my controlled transaction. Whatever B is price charging to third party, this is called uncontrolled transaction. This is called internal cup. Whatever third party is charging any price, any other market supplier is supplying the same goods and same services to the third party, again, this is called external cup. So this is the example. What is external cup? What is internal comparable uncontrolled price? Important thing is, whenever we are comparing the controlled transaction with the uncontrolled transaction, there are two possibilities. One possibility is there no difference. If this is a no difference, it means price of the controlled transaction will be same with the price of the uncontrolled transaction. If there is a difference, this difference can be due to nature, circumstances, volume, place of delivery, input terms, nature of the goods. Their payment term might be different. I just wanted to give you an example. If A is selling to B, if A is selling the goods to B on 90 days payment term, and A is selling to C on 160 days payment term, for sure the price will not be different. Then we need to make the adjustment. So I use the word under the similar circumstances. Whatever the pay, if everything is same, the price should be same. If everything is same, Again, coming back, quantity, volume, discount, income term, payment terms, nature of the goods, delivery term, A, B, C, D. If everything is same, then the price, whatever A is charging to B, the principally, the same price should be A and C as well. Whatever the price A is charging to C, A would have charged the same price to B as well. But if there's any difference, we need to make the adjustment. So this difference, so before, without adjustment, if everything is same, price will be same. And if there are difference in functions, nature, delivery of the goods, input terms A, B, C, D, then we need to make the adjustment. And after making the adjustment, again, price will be same. So price can be same without the adjustment if everything is same. And if there are difference in terms, then we need to make the adjustment. And after the adjustment, principally price should be same. So this is called none of this is the wording I have taken exactly from the OECD guidelines. Whatever they have written, uncontrolled transaction comparable to controlled transaction is a comparable uncontrolled transaction between. Then for the purpose of cup method, if one of the following conditions is met, none of the differences reasonably accurately adjustment. Commodities. Cup is best suitable method for the delivery of the commodity. Cup is the best suitable method. I think we have discussed the same thing in our previous lectures as well. Cup is the best suitable method for the delivery of the commodities. Where then in this is the cup is used to determine the arm's length price for the commodity transfer between related parties and connected persons. Physical product for which the quoted price, such as the benchmarks used by independent parties, are usually available into the market, and we can take the quoted price as a transfer price. If the quoted price is not available, then we need to see the internal cup. External cup, principally we need to go for external cup. If external cup is not available, then we need to go for internal cup. So any of this, otherwise, if the price is same as I mentioned earlier, then this is fine. If the price is different, then we need to make the adjustment based on the circumstances. So application of the goods of sale, whenever we're delivering the goods, if the goods are being delivered between the two parties, what we need to assess? We need to assess the physical feature of the goods, quality of the goods, contractual terms of the goods, volume, arrangement, period, delivery, timing, transportation, insurance, foreign currency terms, input terms, A, B, C, D. Think like this, you are making a transaction with any third party. If you are making any transaction with any third party, you would have considered all these factors. And it might be, if you're making a transaction with the related party, might be you have not considered all these factors. And whenever we are making the adjustment, we need to consider, okay, just I wanted to give you an example. If A is selling the goods to B, A is giving 10% discount. And if A is selling the goods to C, and this 10% discount is applicable if the B is taking 500,000 units of goods. This is the internal policy of the company. Internal policy of the company is someone is buying the goods more than 500,000 units, they will give a 10% discount, assuming. And if A is selling the goods to C here and the quantity is only 100,000, then for sure A will not give the discount to C. This is the factor we need to consider. That's why I said we need to consider multiple factors to make the adjustment. And these multiple factors can be physical features as the quality, contractual terms, volume, arrangement, period, delivery term, transportation, input term. I just wanted to give you an example. If you sign an input term on one party, you assign an input term on X work, a second party, you assign input term of DDP. So deliver duty paid and adhere the extra work. Then transportation cost will be there. This will be required the adjustment. In the same way, some economic factor we need to consider the volume, duration, delivery term, transportation, insurance, freight. In case we are supplying the services, cup is the best suitable for the delivery of the good, but it doesn't mean that you cannot apply this method for the provision of the services. If you are giving the services, you can apply the cup. And if you are giving the services, then we need to consider delivery, timing, location, mode of the provision of services. All these factors needs to be considered to assess either we are under the similar circumstances or not. This is the example. This example again I have taken from the guideline issued by the Organization for Economic Cooperation and Development. They said in independent enterprise sell unbranded Colombian coffee beans for a similar type quantity, quality as those sold between the two associated enterprises, assuming that the controlled and uncontrolled transactions occur at the same time. Timing is very important as well. At what time these goods are being sold. Whenever we are going for comparison, we need to consider the exact time. Time under the I'm repeating the word similar circumstances mean everything should be same. If not same, then we need to make the adjustment. So there's a Colombian coffee. They said unbranded Colombian coffee, similar type, whatever they are considering, type, quality, quantity. Then again, they said timing. If the only available uncontrolled transaction involve unbranded Brazilian coffee beans, it should be appropriate to require whether the difference in the coffee beans has a material effect on the price or not. So we need to consider whenever this unbranded Colombian coffee is being delivered, then when the unbranded Brazilian coffee is being delivered, both are the unbranded coffee, both are the delivered between the one might be delivered between the related party, doesn't being delivered to the same party. It can be internal cup, external cup. What we need to consider, type, quantity, quantity. Again, they are asking some more factor there as well. They said how this coffee is being sourced, definitely it will have impact on the price. So to make sure, it would be asked whether the source of the coffee beans command the premium. Source of the coffee beans. Source of the coffee beans is also very important to ascertain the price, and it will have an impact on the price to assess, okay, this is the arm's length price or not. This is another example that I have taken from the OECD guideline. They are focusing on the Incoterms. But with one party, they are saying FOB price, and second party, they are using delivered price. This delivered price may be delivered duty paid, might be delivered duty unpaid, might be any one of them. So FOB terms, price will be different. DDU or DDP terms, price will be different. It will be required the adjustment. Another example, assuming a taxpayer sells 1,000 tons of a product of 80 per unit to an associated enterprise in the M&E group, 1,000 tons are being sold at 80 per ton. At the same time, sells 500 tons for the same product 100 per ton to an independent enterprise. This case requires an evaluation of whether the difference volume should result in adjustment of the transfer price. Might be, yes, there is a possibility. If this is the price, here they are selling 1,000 tons at 80, here they are selling 500 tons at 100. Might be there is a policy of the company. Okay, if you are selling 1,000 tons, we will reduce the price from 100. How much it will be around? It will be 20% discount. We'll give you 20% discount, something like this. There is a possibility, but it will be required internal evaluation. So application of internal cup, we need to consider the type of the goods, timing, contractual term, quantity, price of the good, just to make sure. In case of external cup, again, this is the example of the external cup. The price at which the security is being sold to the related party, this is different, and the price at which this thing is being sold to the third party, the different. It will be required to make any adjustment. As I mentioned earlier, the market price and based upon the internal cup, if the circumstances are same price should be charged for the related party as well. And here in this case, where there is a related party, it holds listed security at a market value of 50 million, which sells to wholly owned subsidiaries 22 million. Market value, then we can take it from the listed securities. Market value is 50 million and the company is selling to the related party 22 million, means this is the not market price. Market price is 50 million, then we can take it from third party. Market available from the listed stock exchange price is available. And if they are selling it to the related party as 22 million, it will require an adjustment for sure, because the securities are not being transferred at the market value. There one more example, that company A is in the UAE based furniture manufacturer which produces and sell armchairs to related party. Related party is a B and unrelated party. The armchair similar type, important, similar type and quantity. This is very important. Under the similar circumstances, same quantity, same type, circumstances are same. So principally price should be same as well. So during this period, company B purchased 100 armchair from the A at 500. So basically price, whatever the price A is charging to related party, this is a different price. Whatever the price A is charging to third party is a different price. We need to make an adjustment to make sure that the transaction is being executed at the arm length and the price is same after making the adjustment that we discussed it earlier. This is basically the same explanation of the example. I have called one more example. This is important. So, subsidiary of multinational company in the UAE purchases the component from the MNC subsidiary in UK. When a company, they are buying goods from the UK. Tax authorities in the UAE want to show the price paid for the component is arm length. So, tax authorities in the UAE search for a comparable uncontrolled between the unrelated party. This is basically the external cup. Comparable uncontrolled price for the unrelated party. This is the external cup. They find three companies in the UAE. They purchase the same component from the unrelated supplier located in the UK. The transaction. Now, transaction is same. Quantity is same. Markets are same. UAE, UK. Supplier same. So, the related party, they are charging a different price. And company X, Y, Z, they are buying from UK 1,000, 1,500, 2,000 price is this. This is the price, might be the difference in the volume. So what is the average price? Average price is 11.67. Then we need to make an adjustment. A was buying at a different price. A 14. A was buying the goods at 14 price per unit. Average price 11.6. What is that? 14, 11.6. Total unit A was buying 1200. Adjustment 2796. Might be this is a factor of discount, but just for example purposes, for illustration purposes, I have assumed the rest of the everything is same. So I think you understood what is cup. The price what is being charged for the uncontrolled transaction, it should be the same price for the controlled transaction. This uncontrolled transaction can be two types, internal cup or external cup. If the circumstances are different, quantity is different, volume is different, delivery terms are different, input terms are different, ABC. If there is any difference, the difference of this needs to be adjusted and arm length price needs to be ascertained. This is the simple summary of the cup method. What are the positives of this method? Most direct and reliable way to apply the arm length price. Yes, this is very direct method, because if I'm selling to related party, if I'm selling to third party, whatever the price I'm charging to third party, the same price I need to charge for the related party as well. Most reliable and direct method to ascertain the arm length price. Cup method is preferable over all methods. It has been given in the OECD guideline. This is the line I have taken it from there. What are the challenges basically? Conventional method. Okay. Second, they are asking, if internal cup is not available, how will you identify the external cup? If just think like this, A is selling to B, the price is assuming 100, and A is not selling to any other party. If A is not selling to any other party, how we will make sure that what the price A is charging to B, this is the arm length price. Internal cup is not available. We need to go and find the external cup. Once we're going to find the external cup, might be we'll be able to find the external cup, but before this, we need to ascertain industry, region, volume, quality, quantity, size of the business is very important. If one company is 100 employee and charging to any price, it will be different price. If one company have, 1 million, if another company have 100,000 employee, their price will be different. So whatever the price matured what the price matured and huge size company charging into the market, the price, the new player into the market, they will have a different price. Might be the product that they are offering the same product. I just wanted to give you example. Whatever the price PwC is charging into the market, that price will be different. Whatever the price any other tier 1, 2, 3 firm, another price that tier 2 or tier 3 or tier 4 firm is charging, because quality might be different, volume different, size different, delivery terms different, and assurance specific for the numbers is different. So we need to consider multiple factors. Again, coming back to the discussion, external cup is not available. The most challenging part in the application of the cup method is how to identify the external cup where the internal cup is not available. This is not an easy exercise. How will you identify? There are a lot of databases available. A lot of databases are available. They're huge, it's a huge costly databases. Once we are buying those databases, the database start asking questions. There are hundred of questions. Again, they will coming back. Okay, industry, nature, size, volume, size of the company, how many customers you are entertaining, basically, then status of the customer, multinational, locals, industry of the customers, your business, when the company was set up, and what is the volume that you are dealing, what is the nature, from where you are buying the goods, Incoterms, ABC. They will ask 1,000 questions. If you are assuming thousands of companies in the database, might be you will find 3, 4, 5 companies for external cup. Every other company will be wiped out because the circumstances will not be similar. So this is the most challenging part. How will you identify the external cup if the internal cup is not available? The limitations, we need to make the adjustment. Making the adjustment, we have gone through the adjustment. How we'll make the adjustment? Basically, to find the differences. Again, to find the differences, making the adjustment, this is not an easy task. Then another thing, geographical market exists, utilize the value of intangible functional differences. Again, we need to incorporate all these 10 factors into the method to identify the transfer price. Documentation is required, as Ms. Faiza, she has already highlighted that Faiza has already highlighted that we need to maintain the documentation, and this documentation is applicable for this, and it doesn't matter whatever the method that you're applying, but important thing is whatever the method you are applying, you need to have the documents. Okay, these documents for the cup will be like you need to maintain, okay, pricing formula, agreement, end user, applied premium, discount, pricing date, supply chain information, non-tax record. Why have you applied cup? This might be you need to justification as well. Why have you not applied the rest of the 4 methods? Why have you applied cup? We need to maintain this justification as well. So we need to maintain thorough, complete, comprehensive documentation for the FTA to come and go through the record to make sure that everything is as per the arm's length price and everything very transparent. So we need to maintain the proper documentation. Coming back, what is the conclusion of the cup method? The conclusion is adhere to the arm's length principle. We need to identify the arm's length price, and to identify the arm's length price, we have the multiple methods. Out of the multiple methods, we have picked cup for our discussion today. And for the cup, we need to compare the price of controlled transaction with the price of uncontrolled transaction. This uncontrolled transaction can be internal cup or external cup. Internal cup is very easily available. External cup is hard to find. If the circumstances are same, goods are same, quality, quantity, size, everything is same, price should be same. If the circumstances are different, then we need to make the adjustment. While making the adjustment, we need to consider multiple factors as discussed: location, delivery, physical attributes, quality, contractual term. All these factors we need to consider. Then at the end, if required, we need to make the adjustment. And we need to maintain the credible evidence documentation to make sure that we have applied, we have calculated, we have benchmarked the price for the related party at the arm's length price, and we are not shifting the profit from high tax jurisdiction to the low tax jurisdiction, from one jurisdiction to the other jurisdiction. We are not shifting the profit from one entity to other entity. Whatever the price that we're charging, this is the arm's length price. If you are in need of any support, we are happy to help. Registration, impact assessment, implementation, advisory, and compliance services. I'm here. Faiza is here. Shahid, he has joined us as a director tax and assurance. He is there. Anwar is here. Other rest of the team member are working with us. They are the team member. They are here. Some are assistant managers, some of the tax executives, some are tax directors. We are always here to help you. We are always ready to listen, ready to understand, and ready to deliver. If you have any question, you can approach us 9714-399-488. You can drop us an email at info@crestcooper.com. For sure, we'll revert back. Thank you very much for joining us. I really appreciate it. If you have any question, you are most welcome. Aisha Siddiqui, hey, okay, voice is doubling. Okay, I think hopefully it will be fine now. almost. I just gone through your message. Apologies for this. I would have seen earlier, but just gone through your message. Next time I'll be careful. One more, how to get information external cup. I have mentioned this is the most challenging part. This is the most challenging part in the cup method, how to identify the external cup. And to identify the external cup, I have given you an example. The various databases are available into the market, which are very expensive databases. You need to buy the database, put the basic information from A to Z, then you will be getting out of them. Might be if you're picking up 900,000, 800,000, 1 million companies, might be you will get 5, 6, 7, 8, hardly 10, 15 companies as an external cup. Otherwise, most challenging part is how to find the external cup. Because whenever you are finding the external cup, you need to identify wherever you are based, suppliers are based, customers are based, quantity, volume, nature of the goods, input term, payment term, delivery terms, A, B, C, D, everything we need to consider. Any other question? No? Okay, guys, thank you very much. Okay, one more question. What TP method would you use for the services industry? Service industry, any method you can use. But a lot of people are transactional net margin method. Some people are using cost plus method as well. It all depends. Transactional net margin method is fine. You can apply cost plus method. Thank you very much. Thank you for your time. Thank you, Ms. Faiza. Take care. Thank you very much. Thank you. Bye bye. Thank you.
Thank you, everyone. Bye bye.
Bye bye.